Today we're going to be discussing value investing. This video is going to be a beginner's guide to value investing. I'm going to tell you what it is and how you can learn more about it and then how you can actually implement it. So value investing is picking individual companies that you believe are undervalued. By doing so, this gives you the potential to generate greater returns in the market. It requires more effort, more time, and more research than being a passive investor and buying an ETF that just tracks the whole global stock market. There is also no guarantee that the companies you pick will outperform the market. So this is just a value investing disclaimer. It has potential to beat the market, but it is not guaranteed to beat the market. Value investing in its simplicity is buying something for less than it's worth and then trying to sell it for its worth or for more than it's worth. The inspiration for this video is this book right here, Invested. This book is a really great beginner's intro to value investing. It goes through the story of Danielle Town, who knew absolutely nothing about investing, and how she became an investor and learned about value investing from her father, Phil Town, who is a very experienced value investor. So you get both sides of this from this book. You get the beginner's perspective, but you also get to learn from an expert in Phil Town. I would highly recommend this book for beginner investors who are considering value investing. It's really probably the most beginner-friendly book. So if you do want to learn more about this after you're done watching this video, you can definitely get the book. I'll leave an Audible link and a link on Amazon to actually get the book. If you do purchase from one of those links, you do help support the channel, so that would be greatly appreciated. But now let's dive a bit deeper into what value investing is. This is an investing philosophy that many of the greats like Warren Buffett and Benjamin Graham have used over time. Most people can understand that it makes sense to buy something for less than it's worth and then try and sell it for more than it's worth or its actual worth. But how do you actually determine the worth of a company, and how do you even get to a point where you can buy a company for less than it's worth? So this is where the stock market comes into play. The prices that a stock has on the stock market aren't the actual value of the company. A stock can go up by 10% or down 10%, and it doesn't mean that the real value of the company has gone up by 10% or down by 10%. The price in the stock market is determined by buyers and sellers, and these are real people with real emotions, and that's why in the short term, the price might not actually reflect the fundamental value of a company. In the short term, prices are really determined by emotion and what someone is willing to pay for a share of that company. However, in the long term, the price does tend to reflect the fundamental value of a company. That's just something to remember. In the short term, the price of a stock can be influenced by emotions and many other factors, so it might not reflect the actual value of the company. However, in the long term, it does tend to reflect the actual value of the company. Companies that are listed on a stock exchange are divided up into shares, and you can buy these shares. These shares are then given a price based on what some people are willing to buy it for and what others are willing to sell it for. If you take the current price of the shares and times it by the number of shares outstanding or the number of shares of the company, you get the market capitalization. And this is how much the market is valuing the company at. And remember that the market value of the company may or may not reflect the actual value of the company. If you see great potential for a company and it's undervalued because of a huge market sell-off, it could be a good time to buy it. And this usually occurs with events, and events could be company-based, industry-based, or market-wide based. For example, the event that we are currently experiencing with the coronavirus. The key is that these events have to be temporary. You don't want to invest in a company that has an event that has created huge fundamental problems for the company. And it is very important to try and figure out if this is a fundamental problem or a temporary problem. Because if it is a fundamental problem, the price may look undervalued, but it could just be a terrible investment. Recent examples of this could be JCPenney or Sears. They may have looked very undervalued because they were trading at low earnings multiples. They had very little to no future because of the impact of e-commerce. And they have actually become bankrupt. So buying these companies because they looked undervalued would definitely not have been a better option, because they actually weren't undervalued because of all the fundamental problems that they had. This is known as a value trap, where you think the company is undervalued, but it's actually not because it has so many fundamental problems. Value traps could be because of poor future prospects, lots of debt, or high potential of bankruptcy or negative growth. So these are some things to consider when you're actually buying in individual companies. Make sure it's not a value trap. Now we're moving on to how do you determine value. The value of the company can be thought of as the amount of earnings that it will bring in now and in the future. The value of the business is just the sum of its current earnings and all the future earnings that it will have. This might be a bit confusing to understand, so let me give you an example. If you have a company that generates $100,000 in profit each year, this company would be valued for more than $100,000. There is value in having something that can consistently generate $100,000 each year. The value of a business is the sum of all its current and future earnings. And because of this, you're going to have to look into the future and try and predict the future cash flows and earnings. The only way to actually find out the true value of the company would be to accurately predict the future cash flows and earnings, which is impossible because you don't know what's going to happen in the future. You're going to have to choose a growth rate for the company's earnings, and this growth rate that you choose could be wrong. One way to avoid that is to be a bit more conservative in your growth rate prediction. So how to actually calculate the intrinsic value of a company is something that does take a bit of time to explain, and if I had to explain in this video would probably be 20 minutes long, but I can definitely include those in a different video if you guys want to see that. And I know it can be very overwhelming to start, like where do you even find these companies? Where do you even do these things? Well, the best way is honestly to learn from the best investors. And I recently made a video on the 13F filing, so you can check that out. And you want to be looking at the 13Fs of some of the world's best investors. That's how I really got started. I found some companies that Warren Buffett was looking at, and I decided to research them a bit further, see if I liked them as well. And then I eventually ended up buying some of them. So there are 4 really fundamental things that you need to look at before you buy a company. You want to understand the story of the company. Does this company have the same values as you? And would you want to invest in a company that does what they do? You also want to invest in companies that you're capable of understanding. If you have no interest in oil and gas, you wouldn't want to invest in an oil and gas company. If you're interested in sports or fashion or beer, you can invest in companies that do these kind of things. Think of it as this is your money and you want to vote for your money with companies that match your values and match your interests. Number 2 is a moat. A moat is a sustainable competitive advantage that a business has. This moat allows the company to fend off competitors and generate high returns for many, many years. So a durable intrinsic competitive advantage is an advantage that a company has that is intrinsic to the company. It means that it is so hard for a competitor to do the same thing that they won't even try. One example could be Apple. Apple definitely has a brand moat. It's known as a premium company. It also has potentially a switching moat. And a switching moat just means that it's very hard for a consumer of Apple to switch to Windows. These moats can be attacked in 2 main ways. So you need to try and understand how strong is the company's moat and can it survive from these potential attacks. So the first type of attack is another company trying to do what you do better. So it could provide the same product at a lower price or make the product even better quality. The other potential attack is that another company decides to do something that makes what you do obsolete. So this could be, for example, when computers first came out, it made typewriter companies obsolete. Uber and Lyft making taxi drivers obsolete. These are the kind of things that you want to understand if the company you're investing in can overcome, and if their moat is really big enough that these things won't affect them. The third factor is management. Is the company being run by quality and competent people? This is something that I've struggled to fully research and understand because there is such an information gap between what you as an investor can know about the management of a company. It's going to be really hard unless you're working in the company to actually understand how the management works and if they are good people. But there are still things that we can do. Numbers don't lie. And if a management has been consistently generating good profits and increased the returns of a company, that could be a good sign that this management knows what they're doing. So some things that we can do is we can look on websites like Glassdoor, where employees can discuss the management, where you can learn about the salaries and the culture in the company, and you can see what employees have to say about their own management. You can look at the executives on LinkedIn and see their experience. And a really cool thing that you can actually look at if the management is buying or selling the shares of that company. And this is through something called insider activity. So you can just go on Google and type in insider activity Viacom, and you'll be able to see if the management of Viacom has been buying or selling shares of that company. One amazing quote by Buffett on management is that you want to invest in a company that is so good that an idiot can run it, because one day an idiot will run the company. And the fourth factor is margin of safety. And according to Buffett, these are the 3 most important words in investing. So the easiest way to explain margin of safety is that if a company is worth this much, you don't want to pay this much. You want to pay a bit below that, because the difference will give you a margin of safety, because you know that you're buying for less than the company's worth, and this is the difference of your margin of safety. And what this allows you to do is, because when you're paying less than what the company's worth, you are limiting your potential downside of losing money on the investment. You want a margin of safety because it allows you to have a situation where heads, you win big, and tails, you don't lose that much. And this is a famous quote by Monish Pabrai. And this might seem really overwhelming. How can I do all these things? How can I do all the research that you just mentioned? I'm going to let you guys in a little secret. You don't have to do all of it, but obviously the more you do, the greater likelihood of your success in investing. And you don't have to do it all yourself. You don't get any prize for doing all this research by yourself. There's lots of articles out there of people actually researching companies. There's lots of services, like for example, Morningstar is a really great service. It has sort of a value investing approach where they show you the moat, the management, and other factors with the company, and they have calculations that show you the intrinsic value. You do have to pay for it, but if you're going to take value investing seriously, it might be worth it to have some of these resources and tools that can help you. For me, at least, when I initially started to get into value investing, there is a huge learning curve, but books like these can really help you sort of speed that up. And once you sort of know what you're doing and you've researched a few companies, it becomes a lot easier to research other companies. Every day you're going to learn something different. You're going to make mistakes. You're going to buy companies that maybe, you know, it wasn't really a great investment, that it was like a value trap. It turned out because you didn't do enough research, it was a bad company. I invested in Walgreens Boots Alliance, and then the next day they had an earnings report and the stock went down by 20% because I had no idea what it was doing. As a beginner, you know, it might be a good idea to have 90%, 80% of your portfolio in a passive type of portfolio, and then you can use 10 to 20% to learn more about active value investing and to see if this is something that you actually want to do, and you can see if all the research and all the time you're putting into it is worth it and it's something that you want to consider. That's probably a better idea than just going, you know, I'm going to do value investing fully, and there's a lot more risk to that. If you wanted this whole value investing topic summarized in one sentence, you want to find great businesses that you like, wait for an event or the inevitable economic downturn, and buy your business when it's on sale and the price is less than the actual value of the company. Thank you guys so much for 100 subscribers. It really does mean a lot, and it does sort of motivate me to keep making these videos because I know that there are people watching and that people are interested in the subject, so I'm definitely going to continue doing that. So thank you so much, and I'll see you guys next time.